start off with the Internal Revenue Code is really driving a lot of behind this bill. The tax breaks for individuals and businesses are going to be monitored by the IRS. Penalties are imposed on individuals and businesses that don't obtain health insurance. There's provisions in there for raising revenues to help pay for all of this reform, and all of this is going to be enforced by the IRS. I don't know if any of you read about it during this last tax season. The IRS could not figure out how the educational credits and tuition deductions were on the tax return, and I believe they gave out in excess of $2 million of refunds that they weren't supposed to give out. So with the complexity of this, it's all likelihood there's going to be some issues with the IRS in monitoring this. And it's okay if you're getting a tax refund, but once you start getting penalty notices and you start getting additional tax notices, then it's not fun anymore. And there's a lot of that going on now. Basically, I'm going to go through some of the tax provisions. I'm going to try not to make it that boring and that complicated. And I'm going to go by year, because I think chronologically you can find out what's important this year and then what's coming up down the road. I, too, will not go into 2018. But basically, in 2010, there's several things that are happening. There's a small employer credit. And basically, in order to qualify as a small employer, you have to have no more than 25 full-time equivalent employees. And you can't pay more than $50,000 of average compensation. So if you have 25 or more employees, or you pay on average $50,000 or more, you don't get any credit. So let's just start with that. You also must pay at least 50% or 1/2 of the cost of single coverage for each of the participating employees. And you have to have had a health plan in effect already. So if you qualify for that, now let me just clarify that I cannot go into, I don't have enough time to go into all the exceptions that are always in the law, all of the idiosyncrasies that are built into there, all the little nuances that are in there. I just can't, there's not enough time. Write down if this is important to you, talk to your accountants, talk to whoever your attorneys, your advisors, whoever consults with your health care, and find out whether or not this actually applies to you or not. It also appears to me that if you're self-employed or you're a 2% owner of an S corporation or a 5% owner in a small business, your wages, your hours do not count towards this credit. So you're not counted as an employee. So that's probably a benefit for a small S corporation. It's in play today. It's a 35% credit against your taxes. It's also a credit for regular taxes as well as alternative minimum taxes. The IRS already issued some guidance, a report encouraging small employers to take advantage of this. The phase out, I won't go into too much detail, but there is, I talked about if you have $25,000, from $25,000 to $50,000, it phases out. And if you have more than 10, any employee over 10, it starts to phase out also. So there's 2 phase outs in there. And I'm not going to go into the details of it, but like I said, if you get to 50, if you get to, I already forgot already, if you get to comp greater than 50,000 or 25 or more employees, you're completely phased out. Like Mary mentioned, the adoption credit, one important thing also now is now it's refundable. So if you're considering adoption, it went up by $1,000, but it's also a refundable credit now. I didn't notice on the list of people that are attending here whether or not there were any companies here that are going to be doing research or doing clinical studies on diseases. I think we talked about this a little bit. There's some new therapies tax credit. If you're involved in that, if you have a company that does, you're doing treatments to try to get FDA approval, clinical studies, if you're doing diagnostic diseases or conditions, if you're developing a product or process or technology for therapeutics, you may be able to get a credit and in some cases a grant. That begins, I believe, May 22nd. The IRS has not come out with a form yet. It runs kind of like the R&D tax credit, the research and development tax credit. You have to do a study, you have to submit it. The IRS has to weigh in on it and tell you whether or not you do qualify for the credit or the grant. But the grant's actually real dollars. You'll actually get money. Like I said, you're supposed to be able to submit applications as of May 22nd, but none of the applications, I don't believe, are out yet. The other thing in 2010, I know this is kind of important, but if you're getting married or you have daughters that are getting married and they're going to get a tan for their wedding, you better do it by July 1st because after July 1st you will pay a 10% excise tax at the time you get your tan, and it'll be collected by the tanning salon, and they'll be required to submit it to the IRS. July 1st is that date. 2011, like I said, I didn't notice if there are any drug companies in here, but there's a fee imposed on branded drugs, and the fee is $2.5 billion for the year 2011. And so what they're going to do is you have to submit a report to the Senate Secretary of Treasury, and he's then going to apportion that fee to each of the drug companies based upon their market share of that drug. So I don't know how that's going to work. That's another area the IRS is going to have to monitor. Some of these other things about health care savings were already discussed. Employee W-2s. I mean, that's pretty much it from a tax standpoint for 2011. 2012, I didn't notice anything from a tax standpoint, so now we're up to 2013. And that's where the Medicare tax kicks in. And that's, you already pay on your wages 1.45%. That's the employee portion of that. It's now going to go up by 0.9%. And that's on, well, it's on wages in excess of $200,000, but it's also on joint wages, husband and wife wages, of $250,000. Well, how's that going to work? Well, the best way to explain that is by an example. If the taxpayer earns $150,000 in wages from Company A, and then he also earns $60,000 from Company B in the same year, and the spouse earns $100,000, there's no withholding required on that because nobody went over the $200,000 limit, so the employer is not responsible to collect it. However, you're required to report that on your tax return. So you add up everybody's salary, the taxpayer and the spouse, and that comes to $310,000. Married joint gets a $250,000 exemption. So you have $60,000 of taxable wages at 0.9%. You pay an extra $540. But you need to plan for that because you could be subject to underestimated tax penalties if you don't have enough money paid in. If you put your return on extension and you don't have enough taxes paid in, you could also be subject to late filing and late paying penalties. So it's going to be important to kind of monitor that. Then there's also going to be a Medicare tax on unearned income, and that's 3.8% on the lesser of your net investment income or modified adjusted gross income. Now, your investment income is your interest, your dividends, annuities, royalties. I think it's also going to affect the real estate industry. If you invest in rental properties and it's a passive activity, then that's also going to be subject to this 3.8% tax. Now, it's not subject to active businesses, so if you have an active S corporation or a business that earns money, that's not going to be subject to it, but all of your investment income is subject to it. One thing that's not is investment, municipal bonds. So I think you're going to see an increase in investment in municipal bonds. And like I mentioned, it doesn't apply to active trades or businesses, and the tax also applies to estates and trusts. So any of you that have done estate planning out there and have trusts that are out there, it could also apply to them. Remember now, at the end of this year, beginning January of 2011, the tax rate, the highest tax rate on individuals goes from 35 to 39.5%. That's automatic. That's a provision that's already in the law. Now, in 2013, when this kicks in, it could also now add another 3.8% rate to it, so now it could go as high as 43.4% in 2013. One thing I did want to mention is that Roth conversions, because of this, may also become important. And I know this is a provision that happens in 2013. However, in the year 2010, you're allowed to convert your IRAs to Roth IRAs. And there's no income cap anymore. So anybody that has an IRA can basically convert it, and you pay tax on the conversion, the income, but then you don't pay tax in the future on any future earnings or any withdrawals. Now how does this work? I'll give you a quick example. You have a husband and wife. They're both retired. They both have large IRAs, and they earn interest and dividends of $250,000, and they have no other adjustments to their adjusted gross income. So in this case, they have $250,000 of interest and dividends. They get a $250,000 exemption. They pay no tax on their unearned income. But now it comes to 2013, and they have to take a distribution from their IRA account. So let's say they assume that they take a $100,000 distribution. Well, that goes into your taxable income and into your adjusted gross income. So now I have $250,000 of interest and dividends. I add on top of that $100,000 of my IRA mandatory withdrawal, I now have $350,000 of modified adjusted gross income. Subtract my $250,000 exemption, $100,000 now of my interest and dividends now become taxable, and I'll pay a $3,800 tax on that. If you convert it to the Roth IRA, I have no required mandatory distribution. I have $250,000 of interest and dividends. I still pay no tax. Even if I take a withdrawal, the withdrawal is not included in adjusted gross income. So since it's not included in adjusted gross income, I still only have $250,000 of adjusted gross income, my $250,000 exemption. I'm not subject to the tax. So I think, we've all, from an accounting standpoint, we've all been looking at our clients and saying whether or not we should make and there's a boatload of considerations before you actually make that conversion. This is just one more reason to actually take a hard look at it to see whether or not it makes any sense. Also in that same year, itemized deductions, right now it's subject to, you have to have medical expenses in excess of 7.5% of your adjusted gross income. It goes up to 10% in 2013. Medical device manufacturers are now would also be subject now to an excise tax of 2.3% of the price in which the medical device is sold. Doesn't apply to eyeglasses, contacts, basically hearing aids, things that are, bought by the general public. 2014 brings in a boatload of regulatory issues, but it also brings in the assessable payment that Mary mentioned. And so if you were a small employer for under 50, now for this purpose, you're a large employer if you're over 50. And the rule applies to large employers, which employ on average at least 50 full-time employees on business days during the prior calendar year. There's some exceptions in there, seasonal workers, and depending on how many days you go over 50. But basically, a full-time employee is over 30 hours, and you have to take into part-time employees when you figure out their full-time equivalent. And you can't set up separate businesses because if it's commonly controlled, basically under the pension rules, then you're going to be considered one employer and you combine everybody for the testing person. If you fail to provide, or if you provide and somebody goes into the exchange and gets some credits, then basically you're going to be subject to a penalty. Well, an accessible payment. So let's say you fail to provide. You're not going to provide any essential coverage to your employees. And at least one full-time employee is certified that he's gone into the qualified health care exchange and he's gotten insurance and he's received a premium tax credit or a cost-sharing reduction. So basically the penalty is $2,000 per employee for employees in excess of 30. So for example, and it's by month, so it's not, $2,000 is an annual, so it's $166 a month, basically. But, and you calculate it monthly, which for our purposes, let's just deal with an annual. I didn't supply any insurance. I fit into this. So I'm G Corporation. I have 90 employees. 10 go and get a premium credit. So I have 90 employees, less 30. So I have 60 employees that qualify for this, and it's $2,000 per employee. I pay $120,000 accessible payment, and it's non-deductible. Now, the next flip is I'm a large employer. I do provide insurance, except I have one employee that goes into the health insurance exchange, and he or she gets a premium credit or a cost-sharing subsidy. Now I'm also subject to some kind of an assessable payment. And that's basically the same thing. It runs by month, $250 a month or $3,000 a year. And I multiply that, let's just go on an annual basis, $3,000 times the number of employees that went into the exchange and are getting this credit. So for example, I'm back at G again, except I have 100 full-time employees. 10 of them receive the credit. Well, 10 times 3,000, I pay a $30,000 payment, and I do not get a tax deduction for it. Now it's capped. I go back to the first calculation, which is if I didn't apply it, and I take 100 minus 30 or 70 times 2,000, 140,000, and I pay the lesser of. So I pay the $30,000. But in either case, I could be paying an additional penalty.